Attendees are in listen-only mode.
Good afternoon and welcome to today's short-form market update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. The format for today's presentation, it is a short form webinar, so we do a quick summary of global macro outlook. We look at specific stocks within the ASX top 50, and in today's recording we look at our property exposure that we're running within the top 50 stocks. We look at the FY14 earnings per share outlook on those stocks, and we conclude with a short-term summary of some of the portfolio allocations in light of sort of that macro strategy that we're running and the shorter-term Australian market outlook. If you'd like to know more about the services that we provide up on screen there, please contact either myself or Christine, info@investorsignals.com. Up on screen there's a graph of the Dow, and in last week's recording I just highlighted, just from a pure technical standpoint, that we started to see some added buying coming in on the recent sell-off of the Dow, and we've started to see this rally occur. The index, from a PE standpoint, is reasonably expensive. We see fair value for the Dow back at about 14,500, and our base case is that equity markets remain well supported, and we think they're likely to probably consolidate at the top end of their valuation range. If we go to the overnight news, we had inflation data out of the US. It was very benign, so whereas the Fed Reserve has a target inflation rate of 2%, the inflation rate for August was really roughly around a 0.1%. So from an inflation standpoint, the argument would be that if the Fed is going to engage in a reduction of the tapering, it should be quite a mild response, given that inflation is running below the target rate in the US. So we have the FOMC meeting tonight, and we'd expect to see comments out over the next 24-48 hours around what the Federal Reserve strategy is going to be in winding back those stimulus measures. On a positive front, Germany's economic sentiment soared to its highest level in over 3 years, so hopefully that continues to add weight to a general recovery there in Europe, which should aid the prospects for China continuing to stabilise and print slightly better data in the months ahead. Crude oil fell to the lowest level in 4 weeks as an agreement with US and Russia to eliminate serious chemical weapons, obviously reduce the risk of conflict in the region, and obviously that's also had an impact on gold, where we see gold price back down to around 1,300 an ounce. Now, if the FOMC do have a more mild response to tapering, we could see gold find support at around 1,300 an ounce. So from a valuation standpoint, as I'd mentioned, I think the argument is that allowing for about 8% earnings per share growth into 2014, the Dow's worth about 14,500. I think generally with global bond yields at historical low levels, albeit they are rising, and I'll jump to a graph of the 10-year treasuries in a moment, I think equities are well supported. Makes a lot of sense to continue to have an overexposure to equities. However, the prospect of consolidation occurring over the next 3 months I think remains reasonably high, and we're still looking for a stronger start to 2014. As I'd mentioned, let's just move to a quick look of the 10-year treasuries. We occasionally have a look at this just as a benchmark for where we see US interest rates heading, and the impact here that is obviously as the interest rates in the US go up at the margin, we could start to see a slightly slower growth rate in the housing market. It does mean that business refinancing comes at a slightly higher price. and generally we'll get to a point where it acts as some type of drag on the economy, albeit at this point in the cycle, you'd expect to see interest rates back up at around 4%. So we're still seeing rates at relatively low level, and I think in the face of low inflation, we're probably likely to see interest rates in the US stay between 2.5% and 3%, and I think in that type of range, equity markets can continue to perform strongly, or again as a minimum consolidate at the levels we're at the moment. Okay, up on screen is a graph of the XJO. We're trading about 14.5, 15 times 2014 earnings, so it's expensive. I've spent a lot of time chatting about that. Again, though, with RBA coming out, the minutes to the September board meeting where the RBA left rates unchanged at 2.5%, maybe there's a chance that we see another 25 basis points in November. We think there's probably at best a 50-50 chance of that. Either way, I think we're getting pretty close to the end of the easing cycle here in Australia. We're seeing a combination of the fact that yields are creeping up in the US and that we're probably at the bottom end of the easing cycle here in Australia. We're starting to see money rotate out of that defensive yield trade, and I'll just look at a couple of quick examples in today's recording after we look at the property stocks. Again, we've set portfolios up. Our base case through till the end of sort of October, mid-November, was that the XJO stayed within a range of 5,200 points down to 48 support, sitting at the top end of that range at the moment. I do think that we could, in line with the US, sort of moving into a period of consolidation, we should sort of stay within this sort of 53 resistance, maybe back to 5,100 over the course of the next sort of 4 to 6 weeks. I still think there's some good buying opportunities within our market, but it has to be complemented with a covered call strategy to drive the income out of those investments. Okay, so let's move straight into the first of the property stocks that we have exposure to, and today we focus on the three names that we like within the property sector, which are Mirvac, StockOne and Lendlease. We own all these names in the portfolios, and the other property plays within the top 50 we're not owning. So the focus here is that we were buyers of Mirvac at around 165, roughly sort of 3 weeks ago. Our target is to take profit up at around somewhere around 178 to 180 we think is resistance, and the logic for that is the company's forecast to grow earnings somewhere around about 8% into 2014. The stock trades on a roughly just over a 5% dividend yield, and roughly around 14 times next year earnings. So we see it, the prospect of them delivering substantially more than 8% growth, I think, is reasonably limited, but we're drawn to Mirvac as we think it's probably one of the slightly more defensive growth outlooks within the property sector. So again, we've been owners of it in the last month at these lower levels, and on a push another few cents higher into that sort of $1.80 or high 178, 179, we'll start to look to take profit, and that'll provide a substantial return on an annualized basis, given that we would have only owned it for a month or so. The other name that, and just to put some specific numbers around those earnings, so the earnings per share in 13 was 11 cents. We're looking for that to grow to roughly 12 cents into 2014, and it's paying roughly a 9-cent dividend. So it puts it into context just what that payout ratio is relative to its earnings per share. So it's below the 100% payout ratio that some of the property trusts are running. Obviously, the Mirvac has the more of a development pipeline as well. Moving on from Mirvac, I should say, on to Lendlease. This is the other property play. So again, we own it at lower levels. We collected the recent 20-cent dividend. We've sold the 10.25 calls, which will give us an effective exit price of 10.50. So they expire at the end of November. So in the case of Mirvac, the case of Lendlease, I should say, the market's not looking for a lot of earnings growth into 2014. We think that's where maybe some surprise could come in. I'd expect Lendlease to deliver somewhere around about 96, 98 cents of earnings per share. It delivered 94 cents in financial year 13. The stock trades at about 11 times 10.5 times earnings and should deliver, roughly around a 4.5 to 4.75% dividend yield into 2014 on these numbers. And finally, StockOne is the other property play that we have exposure to. Again, we own it at lower levels down here at around 350. We've sold the 370 calls into the end of September, allowing for the call premium that we collected on those. We're getting an effective exit price here at around this $3.90, and we think that sort of captures full value for StockOne. So to put some specific numbers around the earnings trend there in StockOne. So in 2013 it delivered 22 cents of earnings per share. We see that growing again roughly 10% into 2014 to deliver roughly 24 cents of earnings per share. I highlight that the dividend per share here on StockOne's is around 24 cents. So here's an example of where a property play is getting close to 100% payout ratio of its earnings per share. It puts it on a yield of around 6% and about 16 times earnings into 2014. So you can start to see where we build a view that it starts to get a little bit expensive up at these levels. So we're happy to take profit and effective exit price up at around $3.90, and we'd certainly be happy to take a look at it again on any market weakness that presented a new buying opportunity in StockOne's. Over the course of the last week, just to recap sort of some of the activity on client portfolios, we've been buyers of Computershare again throughout the week, again selling sort of calls up at around this 10.50 level. When we look at the numbers on Computershare, the stock trades at about 16 times 2014 earnings. It should deliver about 50 cents of earnings per share into 2014, and its dividend per share is roughly 30 cents. But at 16 times earnings and maybe 10% earnings growth into 2014 at around 10.50, we start to see that expensive. Given that they do have a fair bit of US dollar earnings, it's one of those plays where we continue to be attracted to some of these US dollar earners and the conversion back to Aussie dollars. I do see that even in the event of a market sell-off, Computershare should be reasonably well supported around that 9.75 level. The other name that we're active with again during the week, which we have been over the last month or so, has been Brambles. Again, we were buyers of it at lower levels. We're selling calls up at around the 9.25 to 9.50 level. I think that captures the upside. I spoke a bit on Brambles last week on forward earnings. It trades about 16 times earnings, trades at about a 3.8% dividend yield, should have earnings per share of roughly 54 cents in 2014, and its payout ratio on that's around 31 cents. Continue to like Brambles, so we've been active buyers of that during the week. Telstra, here's an example where sort of whilst we like Telstra, we think this falls into that category where we're seeing a bit of money coming out of the yield trade at present. I do think it's a little bit of a short-term phenomenon. At the end of the day, yields are still at 2.5%. We've got the prospect of a further rate cut in November. A combination of that rate cut occurring in November, if it was to, and the fact that these stocks come into their dividend-paying period in the early part of the new year, should start to see these stocks actually put in a low over the coming month. So we're not too concerned that there is some short-term capital flowing out of some of these yield names at the moment. The other name that we're active in during the week is Fox. I think the companies should grow earnings to around about 8%, maybe as high as 10%. We're buoyed by the fact that the company's still got a further $4 billion of buyback to do over the next 12 months. I think that puts a floor under the stock, so we're owners of it at this level and selling calls at slightly higher levels into the end of the year. And finally, just the activity that we've been involved in during the week, Amcor. Again, I chatted a fair bit on this one last week, but just to refresh your memory, on forward earnings, the stock trades at about 16 times earnings, a little bit above 4% dividend yield. in reality, the stock's fair value back at around 10.25, but I think the fact that the upcoming demerger is going to occur will keep the price well supported. So even for new money coming into the market, we're happy to buy it at levels slightly higher than our value range of 10.25 and sell the covered calls to complement the income out of that. And really, we're sort of buying time on some of these defensive strategies, driving some cash flow out of the call premium and setting ourselves up to reposition the option strategy into the early part of the new year, where we'll collect the call premium and the dividend income. So that's it for the activity of this week. And just to have a quick look before I get to the portfolio summary of a couple of these yield names. So Woolworths, again, I spent a bit of time chatting about this and the high valuation that it trades on, and I'll just summarise a couple of names here. So Woolworths trading at about 17 times forward earnings on a 4% dividend yield. It's expensive, but again, versus 2.5% RBA cash rate, we think that Woolworths makes sense to own, albeit we recognise that you're not going to get a lot of capital growth out of here, even with the business growing earnings at around 4 to 7%. So we're on any pullback back down to around 33.50. We're happy to be accumulators of Woolworths again. Similar issue here with Wesfarmers. So great business, growing at about 6 to 7% in 2014, but it's trading 19 times earnings on a 4.75% dividend. So again, we see value back here at around $39, where we're happy to continue to accumulate the stock, but it is getting expensive up here. So great examples of where you need to be selling the covered calls to drive that cash flow. So we're turning these into names that, in a market where they're likely to move sideways for some time from these levels, instead of getting a 4% dividend yield, where as a combination of the call premium and the dividends, we're driving annualized cash flow out of these names in excess of 10%, and still giving the opportunity for some capital growth as well. Okay, and so again, it's a short form webinar this week, so that's really to capture the two key issues in the market at the moment. We're seeing good momentum in these property plays, which we've been owning from lower levels, so we're looking to take profit in those names into the end of September in Mirvac and StockOne. And in the case of Lendlease, we're looking to take profit on that name into the end of November. These yield names, just drawing your attention to the fact that we are seeing a little bit of money rotate out of them as they get a little expensive. However, we're not concerned about that. We see it as an ultimate, if the sell-off was to continue further, it would create a good buying opportunity, and we think these are good names to own in portfolios with the complemented covered call strategy. And where we're allowing growth in the portfolios, those US dollar earners in Computershare, Brambles, Amcor, Westfield Property Trust to some extent. We see this name as reasonably well supported here and moving up to around this sort of $11.50 range. And just to conclude quickly on the resource names, so a quick look here at BHP. So roughly around 10 to 15% earnings growth into 2014. The stock trades on a forward dividend yield of almost 4%. We owners of BHP in the portfolio, we see it as support down here at around this $35, $36 level. I think into the early part of the new year, we should see BHP push back up to around $38 to $40. I think a lot of analysts have lower iron ore prices in their models, and again, I chatted about that last week, where analysts have been pricing earnings growth on the basis of around $125 a tonne. We could see that average closer to $135 to $140, and that should result in earnings upgrades for BHP, Fortescue and Rio. So we'd expect those names to be reasonably well supported. And the other commodity name that we've obviously been buyers of at lower levels here is Woodside Petroleum. From a valuation standpoint, the stock trades at about 12 times 2014 earnings. It's on roughly a 6.5% dividend yield. The market's looking for, again, sort of high teens, maybe around 14% earnings growth into 2014. I think at around sort of this $38 to $39 level starts to look reasonably expensive short term, so we're owners of it at lower levels. We're happy to take profit at or near this point, and again, if we were to see a sell-off where the stock pulled back to around $35, $36, we'd certainly look to reaccumulate Woodside at or near those levels. Just to conclude today's recording with a quick look at the XJO again. So our base case is that equities are well supported. It makes sense to continue to have a above average exposure to equities. We do think that in light of the fact that valuations are reasonably stretched, the argument is that the covered call strategy is needed to drive the additional cash flow out of portfolios, and it's a matter of striking that right balance between sort of those defensive cash flow names and allowing for some growth in those US dollar earners. Thank you for listening in. I look forward to speaking again next week.